Good morning, everyone. My name is Attila Tóth. I'm Chief Strategist at Cognitive Creators. Let me start by telling you a quick story. It happened roughly 2 months ago when my phone rang and my business partner calls me and he says, Attila, I just had a call with a very desperate investor. It turns out the company invested in lost 60% of its revenue from 1 month to another. And basically, this company had multiple physical locations. They had an online store. And what they did post-acquisition, the first thing was to modernize the e-commerce system. And normally that's a good thing to do. However, the strategy they chose was to use a new website with a complete different link structure. So how technical people call it, the URLs were different. Now, from being in the first position of search engines like Google, Bing, AI engines like ChatGPT and Perplexity, they completely disappeared. And that cost them 60% of their revenue. Now, you might be thinking, well, this is kind of an edge case. But you would be amazed how many companies fall into similar errors, which basically wash out millions. And I'm here today to tell you to reconsider how you do due diligence. And you might be thinking, well, we have a professional M&A or a professional DD company to do that. But in reality, these companies use really old frameworks. Even the biggest ones have really outdated frameworks. And today I'm going to bring you two examples to show that. Probably some of you saw in 2021, JP Morgan acquired a college financial planning startup called Frank for $175 million. What they didn't know when they invested, that from the company they acquired, the data, 90% of it was fabricated. 90% of fake users. Now here's the kicker. With a simple website traffic check, they could have seen the red flags. And I'm going to teach you how. So the company said they had 4 million users, right? Now the first question to ask, whether has this company sufficient amount of website visitors to generate that number? In this case, it would mean they would need at least 160 million website visitors. That's because usually 50% of the website visitors drop off quite quickly, so they don't get engaged. They come to the website and just go. So you're left with another 80 million. And let's assume this company had a great value proposition, great messaging, a really good UI, user experience on their website, and had a 5% conversion rate. And they get to 4 million users, right? Now, this is a super simplified conversion funnel, but even such a simple check would show the first red flags, because Frank never ever had even close to 160 million total visitors. And I'm not here to point fingers on JP Morgan, rather to show you how such mistakes can be simply and easily avoided, and in their case, more importantly, to avoid the reputational fallout that echoes even today. Now let's move to the next one. I assume everybody in the room knows CNN, right? But probably only a few of you know CNN Plus. CNN Plus was a streaming platform created by CNN. The company invested $300 million just to shut down the project within a month. So what happened? Investors basically had two fatal assumptions. The first one, that CNN's brand was powerful enough to drive subscriptions. And the second one was that they thought people are willing to pay for premium news content. Now, let's data check both of these things. What you see in this chart is the relative digital popularity of CNN over the last 2 decades in its category, which basically shows how popular CNN as a brand is. Now, let me overlay on this Netflix. I think no explanation is needed, just how far behind CNN was compared to Netflix. And this should have been one of the first red flags. But let me dive deeper because it gets more interesting. Demand signals for such a service like CNN Plus were never there. In digital, you can look for demand keywords, which are basically search keywords like buy, price, compare. But when you launch a new service, these don't apply, so you have to be a bit creative and try to use creative proxies like premium or exclusive. Now, if we look at the data, we'll see that for searches like premium news or exclusive news channels, they were no more than a couple of hundred results. And when you have less than 1,000, we call these intent signals, and you're trying to build a multi-million-dollar subscription business, this is not ambition. This is a major red flag. Now, enough with the negatives. Let me tell you a positive one of a lesser known case. So let me show you behind the scenes of how actually investors saved millions. A private equity company wanted to acquire a portfolio of hotels. Now, the hotel's financial valuation was done by a reputable commercial and real estate valuation company, resulting at an $82 million sales price. And they didn't leave too much room for negotiation. Now, the private equity had a 5-year exit strategy in mind, which also included to double the average number of rooms booked. So they wanted to make sure there's nothing to hinder this growth strategy. And to do this, they decided to audit the hotel's digital assets. And they did this through a process called Digital Due Diligence. Now, this is what they found. The hotels had multiple websites, and they also were using the platform Booking.com. Now, all the bookings that were coming either from the websites or the Booking.com platform were not automatically transmitted here to the PMS. There was no bridge. Instead, what happened, people from the back office had to take all the bookings one by one and then put it in the property management system. This created multiple challenges and sometimes even chaos. Now, I want to highlight one thing here. When at seasonal spikes, the number of average bookings doubled, the time needed to create all the management and put it in the to the property management systems was 50 times more. So basically, all their people were trying to sort out how the rooms were being booked. Now, through digital due diligence, the private equity on one end saw this issue, but on the other end saw the options how to solve it and the time and cost, what would we need. And in this case, it was a 6-month integration and modernization, which costed about $2.3 million. So with this information, the private equity basically went back to the seller and said, okay, let's renegotiate the 82 million, deducted 2.3, and ended up buying it at $79.7 million. And this is how they saved millions, because then they could use the money to modernize the system and prepare the hotels for growth. Now, all of you in this room, investors, can achieve similar success. This is the formula. So you just add 1D to DD. Let me explain it. Conventional due diligence, or how I like to call it, the old due diligence model, has mainly 3 dimensions: financial, legal, and commercial. Now, to avoid such blind spots and to find out where are hidden opportunities or risks, you need to add another dimension, which is the digital dimension. And what's important, I want to highlight, I'm not talking about forensic accounting or complex KYC processes or not even massive consulting projects. What I am talking about is digital intent signaling, demand modeling, customer experience mapping, and evaluation of risk in terms of software and data. Reports that can be uncovered from objective, data-driven technology and market audits, and these reports that are currently missing from the old due diligence model. So the next time when you invest and you are using the old model, you are not only flying blind and missing these red flags, you're actually leaving money on the table. So I'm asking you, why waste millions? Instead, use the new model and save them and invest with peace of mind. If you want to continue the conversation, here's a QR code. You can book a meeting with me and my teams in the exhibition room. Look for cognitive creators. Thank you.